So this old guy has a pretty big impact on what actually happens to your money and how much you can earn from it. Here's why. Unless you've been living under a rock, you'll realize that the US Federal Reserve has been cutting interest rates, and it started this process last month by slashing its key benchmark rate called the Fed funds rate by 50 basis points or 0.5%. What does that actually mean for investors? Let's find out. The most obvious impact is that yields on safe assets like Singapore T-bills or Singapore savings bonds are going to start coming down, and they already have. If you see last month in the Singapore 6-month T-bill auction, the cutoff yield was 2.97%, and that was the first time it was below 3% in 2 years. Another consequence is that banks have done rather well, at least in the US, from charging higher rates for loans to lenders, but they're not really giving savers much in terms of interest. Yeah, and that's not too dissimilar to what we're seeing in Singapore, where interest rates are starting to come down, but home loan rates, for example, are still pretty elevated as the banks still try to hold up their net interest margin and their net interest income. One of the biggest consequences of interest rates falling is that when people start moving their money out of safe assets like Singapore T-bills, savings bonds, and money market funds and start putting it into riskier assets like stocks. If we look at the S&P 500, it's recently hit a record high, but in fact in 2024 it's notched up over 70 record highs. There you have it. As the Fed starts to cut interest rates, yields on safe assets start to come down, but yields on the loans that you have to pay are still pretty elevated. And then finally, people are going to start moving their money out of safer assets and into riskier assets like stocks. For more personal finance and investing tips, just follow me.